APAC's asset and wealth management industry recently saw. India's asset management sector reached new heights, Singapore looked to expand the power of its financial regulator, IPOs in Hong Kong hope for a 2024 bounce back, and a boom in ETFs and equity fund launches in China. Let's take a deeper look at these, as well as other headlines and developments. And now to China. Over in China fund news, in public funds, following the creation of the CSI A50 index, an index which tracks 50 sector leaders across China, and which launched in early January 2024, several of China's leading public fund management companies have submitted applications to create ETFs for said index, tapping into rising investor demand for passive strategies. The top 3 allocations for the index are industrial, financial, and consumption stocks at 19.2%, 14.9%, and 14.5% respectively, with healthcare and new energy sectors also represented strongly compared to existing benchmarks. ESG themes are also prominent in the index composition. Over 2023, 43 broad market ETFs were launched, raising a collective 35.9 billion RMB in assets at launch, which had grown to 38.8 billion RMB by the end of the year. Products which tracked the new tech-heavy SSE Star Market 100 index featured prominently, accounting for 30.5 billion RMB of the assets. While mainland ETFs may gain in popularity with the launch of the new index, Chinese investors have withdrawn 2.91 billion Hong Kong dollars in assets from 3 of the cross-border ETFs offered between mainland China and its special administrative region. The withdrawals come as Hong Kong stock market sees its worst start to a year in around 20 years, falling over 6% in the first 2 weeks of 2024, the largest retreat since 2005. Further, FMCs in China are betting that equity products will make a comeback in 2024, after seeing bond funds dominate over 2023 in the face of persistent market volatility, with 23 active equity products ready for launch in January 2024 out of a total of 60 funds prepared, a slight increase on the 56 funds which were prepared for launch in January 2023, though way down from the 161 and 134 funds launched at the same time in 2021 and 2022 respectively. In addition to the 23 active equity products, 20 ETFs, 15 bond funds, 1 QDII ETF, and 1 fund of funds are also slated for launch, with 28 funds scheduled in the first week alone. FMCs will be hoping for signs of life in the market, with average fundraising over 2023 of 908 million RMB, a 12.6% decline from the prior year. Overall, 2023 saw a 10.6% decline in the number of funds launched and a 21.9% decline in capital raised from 2022, with 1,271 funds raising circa 1.15 trillion renminbi. Further, Chinese FMCs are reportedly using feeder funds in response to an unofficial order from regulators which stipulates that 4 to 5 equity fund applications need to be filed for every bond fund application. The order is alleged to have been issued in November 2023 in response to flagging demand for equity fund launches in an attempt to inject some vigor into Chinese stock markets. With investor demand for equity funds still low, FMCs have taken to launching feeder ETFs as a workaround, taking advantage of a regulatory push for the product type. Feeder funds require 10 million RMB in minimum committed assets and for the investment to be held for 3 years. And so far, 9 ETF feeder funds have been launched, each with 10 million RMB in assets, with the launching fund management company as the sole investor for most of them. Further, 6 completed their fundraising over only 1 day. The first week of 2024 saw nearly 100 new funds launched, though each share class is counted as a unique launch, with 34 launches in a single day. The trend is set to continue throughout January, with a further 130 fund IPOs expected, and of these, 70% are equities funds. Over 2023, 795 feeders were launched, a record, up 20% from 2022, with assets raised from these launches falling from 230 billion RMB in 2022 to 86.1 billion RMB in 2023. and between 2019 to 2021, each year saw over 300 billion RMB in assets raised. Giving credence to the unofficial order are reports that regulators have issued window guidance to FMCs, directing them to prioritize equity funds over bond products, with several fund managers reporting the guidance given, though some stated that no specific ratio was given. In China's pension space, China's public fund management companies launched 64 target date pension products, with combined fundraising of 5.8 billion RMB, down 44% from the 10.7 billion RMB seen in 2022, with 15 such products raising over 200 million RMB, an amount seen as the minimum fundraising threshold for the product class. The largest product saw fundraising of 435 million RMB, and 3 others raised over 300 million RMB, according to data from Wind, a Chinese financial information service provider. Further, of the over 400 public retirement products from public fund managers in the market, only 24 saw positive returns, with the products on average seeing losses of 5.86%. Of the 24, only 10 saw returns above 0.5%. The products, specifically Class Y shares, were launched in November 2021 in a pilot scheme across 36 cities and provinces in China, and allow investors to allocate up to 12,000 RMB annually in tax-free investment plans. As of December 2023, there are 753 products in total in the market. Take-up among the products has not been strong, with circa 10 million investors out of a potential 40 million eligible individuals contributing 20 billion RMB in total, or 2,000 RMB on average. Regarding ESG, China saw 166 ESG fund launches over the third quarter of 2023, eking out a 4.9% increase, or 24 billion RMB, in total ESG assets to reach a reported 516 billion RMB. Despite the increase, ESG investment remains challenging in the Middle Kingdom, with inconsistent rating standards, disclosure requirements, and limited awareness among investors, as well as other factors, all contributing. Chinese policymakers continue to drive ESG development over 2023, issuing ESG disclosure guidelines for state-owned entities in July, CSRC, China's main securities regulator, releasing guidance for the Shenzhen and Shanghai stock exchanges to develop sustainable development disclosure guidelines for listed insurers, and CITIC Securities, a Chinese full-service investment bank, expects this trend to continue over 2024. Specifically, domestic ESG disclosure standards are forecast to see significant progress towards a potential 2025 implementation. Many public fund management companies are responding with enthusiasm to the developments, with 32 FMCs signing on to the UNPRI, including 15 of the top 20 FMCs, and in a survey of 40 FMCs, 25 stated they intended to explicitly incorporate sustainable investment into their company strategies. Further, of these 40 respondents, 13 have taken concrete steps by issuing business action plans or have incorporated them into mid to long-term development plans, and 21 of the 25 aforementioned respondents have established goals based on sustainable investment strategies. Lastly, in public funds, more Chinese bond funds are halting large-scale redemptions, with over 120 funds imposing limits already in 2024. Some funds have maximum daily subscriptions of 10 RMB. This continues a practice seen over 2023, in which bond funds limited subscriptions from new investors so as to ensure stable fund operations and protect investor interests. The driver of the subscription limits is due to the strong performance of bond funds in 2023 in the face of lackluster stock market performance. This saw bond fund AUM reach a reported 8.33 trillion RMB as of third quarter 2023, up 271.2 billion RMB year on year at the time. Industry observers see the continued restrictions as stabilizing fund sizes for operational purposes, protecting investor interests with forecast dividend payments coming up, or aligning with fund investment goals and risk profiles. Despite the restrictions, the outlook for bond funds over 2024 is positive, with bond prices rising. Conversely, the subscription limits on several equities and mixed funds have been lifted in a move, among others, aimed at boosting interest in the products and market activity and liquidity, which are otherwise moribund. Some fund managers noted that the move was done in order to meet the investment needs of its investors. Several funds simply reversed moves which limited subscriptions to the funds to amounts of less than 1 million RMB. Whether the moves succeed in driving investor interest and the stock market remains to be seen. In private funds, over half of equities-focused hedge funds in China saw losses in 2023, with the number of such funds with AUM over 10 billion RMB slipping from 116 to 103 between February 2022 to December 2023. As of end 2023, 245 long-short equity funds out of nearly 10,000 had incurred losses, with 790 of these falling by more than 20% and 86 collapsing by 40% or more. The worst performing product saw its assets decline 77%, following up its 2022 performance of a 44% loss. The 2 years prior had been kinder, with returns of 303% and 207%. In aggregate, China's 19,831 hedge funds averaged a return of minus 1.59% over 2023, with circa 47% seeing positive returns. The Dow performance has seen the number of hedge funds managing assets above 10 billion RMB fall markedly, declining to 103 at the end of 2023, with 82 of these behemoths seeing overall losses over 2023, prompting public apologies from some. Hedge funds are also feeling the pinch from regulators, with efforts taken to remove funds deemed fake and poorly run ramping up, and 2023 seeing 2,477 funds losing their licenses, up 267 from the year prior. Circa 3/4 of these removals are classified as deregistration by AMAC, the most damning reason a private fund in China can be required to liquidate, up from the 843 funds seen in 2022. Also in private funds, municipal authorities in Shanghai and Shenzhen have announced initiatives to boost foreign institutional investment in local qualified foreign limited partnership schemes. Since the scheme was first launched in Shanghai in 2011, it has spread to 30 cities and provinces, providing channels for foreign investment into a range of private assets. Both Shanghai and Shenzhen noted that the regulatory changes were done to aid in implementing private fund regulations released by CSRC in December 2023. Shanghai's new guidelines will take effect from 1 February and be in effect until the 31st of January 2029. Officials will encourage qualifying QFLP entities to register with AMAC, China's fund management industry body and quasi-regulator, following more restrictive regulation requirements released by the Industry Association in May 2023. In Shenzhen, QFLP registered entities are able to operate as fund of funds and invest in property-linked AMAC registered private funds. Further, the application process will be accelerated so that the application to acknowledgement to review timeline will not take more than 10 business days. Custodian requirements have also been tightened, requiring QFLP license holders and their custodians to provide quarterly reports showing capital contributions, flow, and investment returns to authorities. Shenzhen is also looking to accelerate the approval of QDLP licenses for firms registered in Hong Kong as it looks to facilitate cross-border private equity investments. So, that is this episode's section on China. To see the full video, check out the links in the first comment below, or take a look at our profile for this episode's other sections. Do let us know your thoughts in the comments below, and if there was a topic or development that you think deserved more attention, point it out to us. Thank you all for watching. We hope to see you next time.